on a morning when Brent oil is approaching $85 a barrel or so after quite a positive week, slightly off towards the end, but pulling away significantly from the sub $80 level it plumbed earlier in the week. I'm joined by three experts who will give us some views on this direction, where it might go, and what are the factors that are influencing it. Let me get, first of all, a view from Dr. Rad Al-Qadiri, Managing Director for Energy, Climate and Resources at the Eurasia Group over there in Washington, D.C. Rad, thank you very much indeed for joining us at this early hour for you. Just give me your broad thoughts, please, if you would. It's been quite a strong week. What's driving it? What direction will it go?
It's great to be here, Frank, and great question. I mean, I think, as we look at it this week, it's sort of China demand story, sort of at the end of the day, that's sort of sitting back and driving markets. Obviously, sort of the Saudi OSPs and the fact that they came in higher than anticipated has given the market a kick and given it further confidence that China is actually on a rebound after its pivot away from zero COVID policy. I think some of the numbers that are coming in after the Lunar New Year are beginning to show certainly an uptick, a significant uptick in mobility, which was one of the signs that the market was looking for, and a sense more generally that China is, going to push a growth agenda driven by consumption, and that can only benefit oil. So I think, in terms of the direction, the market is still a little skittish, as you mentioned. It sort of, flirted with $80 Brent and below at the beginning of the week. The rally that we saw at the start of the year dissipated a little bit, but it's gradually getting confidence. It's going to keep a close eye on Russia. I think is going to be a big part of the equation.
Yeah, we're going to talk in depth about
Russian oil holds up.
Yeah, we will talk in depth about Russia a bit later. Let me go over to Clay Siegel, Director of Global Oil Services at Rapidan Energy Group Consultancy, who is in Dubai and has just spent some time in the Gulf, normally in Houston, Texas. Clay, again, your broad thoughts. Where's it going? What's driving it?
Sure. Thank you, Frank, for inviting me to join today. We're not surprised to see this rally this week, because our outlook for the first quarter is for stronger crude oil prices. We think that Brent will be closer to 90 than where it's traded recently. And the storylines there, as I think Rad has already outlined, are very straightforward. There's probably going to be greater scrutiny on Russian supply as the import bans continue to have an effect on reshuffling flows around the world, and lingering questions about how Russian, especially refined products, are going to maybe struggle a little bit to clear the market in some cases. And that could have follow-on effects for Russian supply on the world market. So we can talk about that in depth. For sure, the question about a rebound in oil demand growth in China, where we have seen it relatively flat between the fourth quarter of last year and the first quarter of this year. Everyone, of course, is trying to figure out when it really takes off again. And for us at Rapidan, we think it's substantially in the second quarter of this year. We can talk about the drivers there in more detail, but those are the two big ones. There's always the possibility of supply disruptions, and we see those not only on kind of the geopolitical induced framework, but also from what's obviously first and foremost this horrible humanitarian catastrophe with the twin earthquakes in Syria. And I bring that up only because there is an oil export dimension of that storyline that we can maybe talk about as well.
Okay, you're referring to the disruption from Azerbaijan and from Kurdistan. Yeah,
from Azerbaijan.
Okay.
Yes.
Yeah. Let me go over to Osama Rizvi, energy and economics analyst with Primary Vision Network in Lahore in Pakistan. Osama, hello. Thank you for joining us. From there in Lahore, give us your global viewpoint here. Is it China? Is it Russia? Is it all of the above?
I believe, to put it, in a brief manner, I believe that we are being affected by everything. As a developing country, as a country that depends upon most of its energy imports, as a country that, despite being an agricultural country, imports a lot of grains because of some issues, domestic issues here. Not only a rising dollar affects us, hence the mechanisms of the Fed are quite concerned here, but also what's happening in the global energy markets in terms of China's reopening, LNG demand, what's going on with the global supply of natural gas, the prices there, and especially, and I did a piece regarding it as well, what will be the weather in Europe, because that is going to dictate the European energy crisis, which in turn is going to affect whether or not we will have long blackouts here in Pakistan, as we just had recently. So Russia is, of course, there. We are trying to get some oil from Russia. So the diplomatic dimension is still there. So I would say all of the recent developments across the world, Pakistan, unfortunately, and countries like Pakistan stand to be adversely affected in a disproportionate manner if things go wrong.
Right. I know that Pakistan has its own peculiar issues and challenges at the moment. We will speak about those a little bit later. But let me dive into Russia, because it seems to me that this is the crux of it. This is the cockpit of it at the moment. And there has been quite a lot of commentary recently, and I think there will be more to come. There was a piece on the News Digest yesterday from oilprice.com, which argued that Russia could soon be out of OPEC plus. Has Saudi Arabia's relationship with Russia reached its limits, was the headline. And the piece argued that the invasion of Ukraine and the disastrous way it's been handled has damaged Putin's image in the eyes of the world as an effective, efficient dictator, operator, and that even his allies are looking to pull back from him. Against that background, I want to ask you, what do you see as the prospects for OPEC plus this year? Has the relationship between Saudi Arabia, the UAE, and Russia reached the end of the road? Dr. Rad, let me ask you that first.
I've never seen it as an alliance. It's been a relationship of convenience. Sadly, those of us old enough to have been in this game for a while remember that it wasn't so long ago that the technical term would have been that sort of Russia was outside the tent pissing in rather than inside the tent pissing out when it came to managing oil markets. It was
very well put. Very well put. Yeah.
Taker, and it was a market competitor. I think OPEC has a relationship of convenience with Russia, and that is simply that OPEC is in the best position to manage markets that it's probably been in 30 years, and Russia's cooperation since 2020 in terms of managing prices, Russia's and the fact that Russia is probably going to be a diminishing producer as opposed to an expanding producer, sort of all makes some tactical sense in terms of Russia and OPEC continuing to cooperate. And I think, from a Saudi perspective, from a UAE perspective, there has been daylight between Western policy towards Russia and Ukraine and what you've seen in the region. But it's not necessarily a strong relationship or an alliance that is sort of managing markets together. I think it's more Saudi and the UAE managing Russia within the context of the overall global markets picture, rather than ever having been a strategic alliance.
Right. Okay. So in oil, it's a relationship of convenience. I'm not so sure that the governments of Saudi Arabia and the UAE was regarded as that from a geopolitical term. There may be a stronger strategic motive behind their relationship there. But Clay, let me ask you about this, because it seems to be, a very important aspect of the whole global oil equation. It seems as though Russia wants a higher price. It's spending a lot of money on its war, whereas Saudi Arabia and even more so the UAE, they want to pump volume, don't they? tell me about the dynamics there. Does that put it all apart in the end?
Well, we don't think so. We think that the cohesion is liable to stay in place for substantially all of this year. I mean, when it comes to the OPEC plus just kind of game plan for the year, it's to keep output flat, like no change to targets. And look at the situation that the Gulf producers are facing. Russia, as we've noted here, is pretty tapped out. US shale growth, which was another huge influencer for the OPEC plus decision making in the past, is flat to maybe just modest. We think maybe 4 or 5% growth this year. These guys have a situation where we see balances between supply and demand tightening right now in the first quarter. So these Gulf producers that are led by Saudi Arabia are in a strong position to manage this market from our perspective, unless demand just unexpectedly falls to pieces. So we think that, right, OPEC plus stays in kind of wait and see mode, but as always, they are ever vigilant for any serious market slump that could require a policy intervention.
Right. Okay. So as you said, this agreement runs till the end of this year. So you don't think it will be called to a halt before then, but will it be renewed? Will it be renewed?
Yeah, that's definitely the key question going forward is, do they still have consensus on agreeing and setting supply targets that work for the whole group? And of course, most of the members of the OPEC plus coalition are producing below target and would have trouble on any front related to spare capacity, which is only held by a couple members of the group. Nevertheless, the consensus does not want to see a return to what was a disastrous kind of early springtime of 2020 with the onset of the pandemic. Yeah. And lack of agreement around supply. And that a situation like that, where it's a free-for-all, does not help any of these countries meet their fiscal targets for oil revenues, does it? So the idea is to hold this consensus for as long as possible. Yes.
Okay. If Russia were to leave the group, what was the immediate impact beyond markets?
I think that markets normally would be concerned that if the OPEC plus cohesion collapses, which is not our base case, then you have to worry about oversupply. But in this situation, like I said, where Russia is obviously very constrained on the supply side, that would not be a dynamic of focus right now.
Okay. Osama, you mentioned that Pakistan has been importing oil from Russia. What's the Pakistan view on Russia?
We have not been importing oil, but we are in talks with Russia to import oil from them, because we know, because of some political events like the vote of no confidence and the somewhat controversial and confrontational stance by the ousted PM Imran Khan, that led to a little bit tensions between Washington and Islamabad. And because of that, Pakistan was quite cautious in its approach to get.
I see. Thanks for clarifying that.
But recently, because of, we are literally on the brink of, and I said this actually in my last appearance at this podcast, that Pakistan is going through one of its toughest years ever since its independence. And that is in the background. So we have a huge fiscal deficit. Our foreign exchange reserves have fallen to $3.6 billion, which isn't even enough to cover 3 weeks of imports. And internationally, it has to be about 3 months of import cover. So against this backdrop, we have restarted our talks, negotiations with the Russian foreign minister and their energy companies to get oil. However, I still believe technically there are some hindrances that might, if not, it might delay such the development. There are technical issues like we don't have refineries that can, refine heavy Russian grade oil. Secondly, the freight rates, we now get our oil from the Middle East, right? So the difference between the freight rates is like $7 to $6. So that really offsets what you're getting from the other end as a discount. Right. Then, of course, you have these long-term vendors in the UAE and other Middle Eastern countries. And I don't know if it is a good strategy to jeopardize our relationships with them just to get a discounted oil, which of course comes with a lot of diplomatic baggage, if I may. We have to negotiate. And currently, right now, only yesterday, Pakistan failed to reach a deal with IMF, which is the only lifeline. There is no doubts about it. And if so we are dealing with IMF. Our relation with Washington is a little bit, shaky. So at this point, I don't know whether we can afford such a dealing with Russia. But that's what is happening. So apart from that, yeah, sorry.
So tell me about the IMF. There was quite an apocalyptic leader in the Financial Times earlier this week saying Pakistan is on the brink, facing its most serious challenges in its history. And the talks failed with the IMF yesterday. Those have been going for some time, haven't they? Can they be revived?
Yes.
Yeah.
So what's going on is that Pakistan and IMF haven't been able to decide the latest, provisions, the latest conditionalities, because those conditionalities involve Pakistan implementing a lot of unpopular measures, such as we'll have to increase the price of petrol, right, which is called gasoline in the US, by 20 or 30, 40 rupees, Pakistani rupee. That is a jump of about 15 to 20% in one day. For that, we'll have to increase the electricity prices by 100% or 70%. Because of the nature of the deficit, as I've been telling, Pakistan posted the second highest budget deficit ever in its 75 years of history. So to cover that, IMF naturally, while giving a loan, wants it to be covered. But the leaders, so there is a big political dimension to this. The dilly-dallying is because nobody is willing to take the blame on themselves. And the delay is translating into social unrests. The delay is translating into a severe cost of living crisis. And you can couple this with the global inflationary level. Our interest rates are at 25 years high. The food prices haven't been this much higher. We spend more than 60%, and every household family here spend more than 60% on food items, basic food items. So what we are looking at is that there might be a chance of a heightened social unrest or civil unrest if this isn't resolved. That is why the latest tranche of IMF, which is about $1.1 billion, as I've said, is the country's lifeline. I believe there have been recent measures taken by the government, such as the free floating of Pakistani rupee, the increases in petrol prices, some increases in energy prices, and I believe we are preparing the grounds for the IMF package. However,
or deal with the IMF.
Yeah, but it is still too early to say, because let's say out of 10 we have done 6, and the 4 points still remain. So unless we do that, which will really incense the common people, there isn't going to be a deal. So they are between literally a rock and a hard place, the government right now.
Okay. Yeah. So, well, that does indeed sound on the brink, as the FT said. We have 2 US-based commentators with us, so I'd like to get a little US flavor into this. The State of the Union address, Joe Biden said that the US would need oil for at least another decade, which some people took as a rowing back from his, sort of previous green renewable position. And we heard the same kind of sounds from BP, who extended their forecast for how long they would be producing and investing in oil. So I would like to ask Rad about that. And in particular, watching the State of the Union, it struck me as almost anarchic. The president was being called a liar from the floor, and people were jeering and shouting at him. Talk me through that sort of narrative, would you?
Well, I think you're looking at sort of the political polarization of the US, and the extent to which there really is this deep division and deep question of legitimacy on both sides of the aisle. I think some of the more raucous behavior that you saw came from a minority of very extreme voices in the Republican Party.
But that was kind of unheard of before, wasn't it? You wouldn't do that to a president.
Absolutely. I think if you go back in history, sort of a little further than sort of our memory, U.S. politics has been divided, and U.S. politics has been raucous. But I think what it shows is the difficulty of making policy in this country, and the extent to which the federal government is divided, and the federal system is divided, and also differences between the federal governments and the states. This is a country of red and blue, and it's a country of red and blue where it is diverging, not converging. And that process continues, and oil and gas and energy transitions are a critical part of that. It's playing out as part of this cultural wars narrative that's often referred to. You can see it in terms of ESG policy, you can see it in terms of other things. But on your point about the oil and gas nature, one of Biden's recognition of that, I think, is a recognition of reality. But it's also underpinned by policy. One of the things that was missed in terms of the Inflation Reduction Act, a lot has been made of that in terms of being green policy. There's no industrial policy, and the elements included, certainly for things like CCUS, things like biofuels, etc., were really incentivizing oil and gas companies to continue producing. I think from an oil and gas perspective, the Inflation Reduction Act delivered a lot of the key issues that they wanted in terms of incentives, in terms of certainty about long-term market. So the administration, for its rhetoric, has not been that devoid of understanding the importance of oil and gas. And what got out of Biden was a public recognition of that, something that maybe we haven't had in the past. It certainly was reinforced what you've been seeing at a policy level.
All right. Clay, you are normally in Houston, in Texas. What would the view of this issue be from down there?
Well, from down in Texas, maybe I can represent, but also just kind of the view here at the firm at Rapid In. I mean, we're not surprised really to see, even on a symbolic level at the State of the Union, this sort of epiphany, this revelation that, of course, demand for oil is going to continue for the foreseeable future and well into for the next decade. And so we've said all along that this is the case, that kind of peak demand is maybe on vogue, but is not reflected in our modeling of the medium to long term. And so the demand for oil and transportation fuels, among other segments, is here to stay. And so I think it's very important on a symbolic level for this to be acknowledged, because in the oil patch and in the industry, we have had the kind of signals from the other side of the ledger for quite some time now, during the first part of the Biden administration, the first half of the term, that started off even on Inauguration Day, and I don't remember, potentially even before, about kind of the end of hydrocarbon and petroleum, which just did not match our understanding of the forward curve for demand. So it's really important at a symbolic level to acknowledge, so that all of the stakeholders in industry, in government, and related, certainly in the investment world, get a signal that we're all kind of on the same page about the continuing expectation for oil demand growth. And that sets the stage for correct policymaking and indeed the investment environment.
Right. We've just had the oil majors profit reporting season, record profits all round, it seems to me, huge bonuses, share buyback schemes. Yet there still seems to be a reluctance by Wall Street, to invest in the independent oil companies, doesn't there? Can that ever change? Clay, let me ask you that.
I'll opine on that. Well, it can change, but I think that we're in kind of a new normal when it comes to the investment landscape for E&P, whether it's at the international level, but particularly, I think your question is about the US oil patch. And investors from now forward are going to be looking at the opportunity to invest in E&P versus other opportunities through a different lens. And it's obviously, as we've seen, a lens that's focused on profitability and returning value to the shareholder versus kind of shale's a previous golden age that was all about production growth and rewarding these operators for growing production. Now, the flip side of the coin there is tight oil and unconventional oil. We all know about aggressive decline rates, and these reserves have to be replaced. And so if the exploration part of the E&P activity is not ongoing, we set ourselves up for a big supply crunch going forward.
Right.
That's the new lens. And the other thing to keep in mind too is the tremendous cost inflation that has taken place in kind of the upstream landscape. And so the cost for labor and specialized parts and proppants and downhole equipment and pretty much across the supply chain is just sort of stage change higher than it used to be. And that's another really important consideration for assessing value on the exploration side.
Okay. Could we pull up the survey question, please? I just want to get people thinking about this for a moment. So the proposition is that the interests of Russia and the rest of OPEC Plus are diverging rapidly, with Putin needing higher prices, while Saudi Arabia and the UAE want to increase supply, demand allowing. In these circumstances, it would be best to terminate the OPEC Plus agreement when it runs out at the end of this year. Please agree or disagree. So thanks. While we're thinking about that, let me go back to Rad, because you did mention at the beginning, Rad, the awful and tragic events in Syria and Turkey, and possible implications for global energy markets. Tell me about that, please.
I think it goes to the point, and I have to say it was Clay that mentioned it, so I've got to give him credit for it. But I think it goes to the point of tight markets, and it goes to the point of where we are at this moment in times in terms of supply and demand. This is a market that is sensitive to any sort of political disruption, and obviously sort of a disruption of movement of crude from Azerbaijan. Concerns about the Iraq-Turkey pipeline and operations at Jehan. We're going to significant volumes going through that particular pipeline and that particular port. And in cases where we are right now, where demand is rising, and really as I think both Clay and I mentioned, supply isn't necessarily there in abundance. You do have, you will have a market that's sensitive to any sort of disruption whatsoever. It looks like it's going to be relatively temporary and it will come back, but this is going to be a feature of the year. Anything that goes up is going to show up in terms of dollars on the price of oil. Okay.
Osama, you are rather closer to this awful series of incidents, not on top of it, of course, and thankfully, but give us a regional view, if you would.
I mean, Pakistan and Turkey, we enjoy quite close diplomatic connections, right, historically and otherwise as well. The atmosphere here is quite sad. We have also pledged support, our help. If I'm not mistaken, some of our officials have also flown to the country, and they have started volunteering and other work. People are sort of pulling out everything from their homes and houses in terms of money and other stuff, sending it to Turkey. So that's the sort of air here. It's sad because we have had such situations back in 2005, 2008. So we can literally feel what it means to have such a catastrophe.
Right. Just to go to the survey results, it seems quite a big majority, overwhelming majority, 73%, disagree with the proposition that OPEC Plus will fall apart by the end of the year. Okay, that's interesting. Let's see where that goes. Are you Clay? I know that you said that was Rapidan's view as well. But are you surprised by the size of the majority there?
No, certainly not. And I mean, our overall thesis is that the market is probably still mispricing the risk of a Russia supply downturn. And it's through that lens that we're thinking about the future of OPEC Plus and the continuing benefits for the members and the efforts that they're going to take to, to sustain the relationship. But again, just to summarize for context, I mean, what happened last year is the market was expecting this big disruption, prices spiked. We all remember what happened in the first and second quarter, and then it didn't materialize. And that plus kind of the macro weakness really unwound that risk premium in the second half of last year. The market ended kind of positioning a little bit shorter than it had been. But we believe that now the Russia supply downturn is coming, and it's going to be about 1 million barrels per day on average versus the 11 million barrels a day that for kind of basis starting point. And so everyone has a different estimate for this, but it's the way the market copes with this, as well as the reshuffle of Russian flows around the world to different consuming regions, import bans, and the price cap, where Washington is kind of, we think, taking a little bit of a victory lap, that are going to set the stage for OPEC's continuing policy decisions going forward. OPEC plus.
Okay. Well, look, thank you all. We have reached the end of our allotted time. So let me thank Radar Kadiri, Clay Siegel, and Osama Rizvi for joining today. Rad, you can go back to bed now, and the rest of us will get on with the day's work. We will speak next week. Hope all of you have a good weekend, and thank you for taking part.
Thanks very much.